Okay, good afternoon, everyone. Welcome to Supply Chain Gatherings. This is the first of 3 sessions that are being sponsored by the National Restaurant Association Supply Chain Expert Exchange. I'm John Barone, president of Market Vision, and I have the honor of being your host for all 3 sessions that are scheduled this spring and summer. A few housekeeping details before we get started. First, to protect the mental health of the speakers, you have been automatically muted and your video is turned off. So please feel free to stay in your PJs and slippers. Second, please submit questions through the Q&A tab at the bottom of your screen. We'll try to answer as many as time permits. A lot of questions were submitted during registration, so we've tried to pre-bake those answers into the presentation. Shockingly, a few of the questions submitted were beyond our areas of expertise, so I apologize if we don't cover everything. And finally, this webinar is being recorded and should be available within a week or so. For those of you unfamiliar with the NRA supply chain group, they're a community of food service supply chain professionals who gather twice annually, once in the spring ahead of the NRA show, National Restaurant Show in Chicago, and in the fall in conjunction with Market Vision's fall conference. The NRA show in Chicago has been canceled again this year, but the Supply Chain Exchange and Market Vision have announced that both will be live in Orlando this October. The supply chain group's purpose is to foster relationship building, education, and mutual exchange of information relative to supply chain best practices. The current chairman is Matt Rilleberger from Firehouse Subs. If you are interested in getting more involved with this group, please feel free to reach out to me or Matt. I'm very happy to have with us today Hudson Riehle. Hudson's title is Senior Vice President of the National Restaurant Association's Research and Knowledge Group, but I usually refer to Hudson as the NRA's Chief Economist. So before we get started, a quick story. Hudson and I have worked together several times in the past, but one that sticks in my head is from 2010 in Orlando. Hudson and I, along with Michelle Schmale from the NPD group, were part of a panel at MUFSO, which is a conference sponsored by Nation's Restaurant News. Our slot was right after the last day keynote speaker, Pat Buchanan. For those of you unfamiliar with Pat, he was an advisor to Presidents Nixon, Ford, and Reagan. He sought the presidential nomination in 1992 and 1996. He got on the presidential ballot in 2000 as the Reform Party's nominee and has been on political talk shows zillions of times over the years. At the time, Pat was still a big deal, and there were probably about 800 people in the audience. So I'm thinking we couldn't possibly have a better lead-in. After Pat's speech, we go to break, we get mic'd up, we come out on stage, and I see that about 2/3 of the audience had left for the airport. This was my Rodney Dangerfield moment, no respect. So that said, Hudson and I get a little sensitive about people bailing early, but I promise that if you stay with us through the entire presentation today, we'll have a lot more of value to say than Pat Buchanan ever did. And with that eclectic intro, I turn it over to Hudson.
Thank you, John, and good afternoon, everyone. On behalf of the National Restaurant Association's research group, it's a pleasure to have a few minutes to talk with you about the current state of the restaurant industry and most importantly, where we see it heading the remainder of this year and beyond. So hopefully you can see the screen currently. And before I actually get started in the bulk of the presentation, it's important to review the association's definition of really what constitutes the restaurant industry. And that is all meal, snacks, alcohol away from home, including all takeout meals and beverages. And it is the latter part of that statement, which we call the off-premises market, which, for example, is takeout, delivery, drive-through, curbside. It is that off-premises market which truly was a lifeline to the industry over the past 14 months. And even pre-pandemic, that off-premises market was important. Looking at all restaurant industry traffic, even pre-pandemic, over 60% was off-premises. And not surprisingly, during the pandemic, second quarter of last year, that approached 90%. It's currently in the low 80% range. But obviously, we're going to spend a little time discussing that off-premises market and the sustained importance of that convenience-driven segment in the years ahead. So one way to look at the economy is looking at gross domestic product. We look at it in terms of real inflation-adjusted terms. GDP, basically just the dollar volume of sales of goods and services in the national economy. So there in 2020, you'll see the real GDP decline in excess of 3%. That is the largest drop in the post-World War II period. And then this year, we're looking for a regain of about 6%. So it's important to understand the mechanics of going against a lower year. And so, for example, even looking at 2021, on a quarterly basis, there'll be different growth rates and different economic growth periods as the year unfolds, and also as the stimulus package impact softens. But as John knows, looking at it on a quarterly basis does tell a somewhat different story over the time period.
Yeah, actually, my forecast is a little bit more aggressive than Hudson's. I've got 2021 at 6.7%. And to give you an idea of where to expect some of the big bumps in business, Q1, first quarter GDP came in at 6.4%. I've got Q2 at 8.2%, Q3 at 7.0%, and then Q4 at 5%. But the big question is what happens after that when the stimulus and extended unemployment run out. And that likely puts first half of 2022 at something like 3.5%, with growth slowing to 3% in 2023. So we're going to go from ludicrous speed in Q1 to plaid speed in Q2 and Q3. Yes, plaid speed, Google it. To just strong growth in Q4, pretty good growth for the first half of 2022, and then eventually to pre-pandemic sluggish growth beyond that. And I would expect that tax hikes and regulatory enforcement will take a bite out of growth in 2022 and 2023. But we don't know enough about those plans yet to really factor them in. So you've now got the NRA's and Market Vision's forecast going forward, and it's going to be a rocking year. Hudson, it's all yours.
And one important thing to keep in consideration is it really is a dichotomy in the overall economy between what's going on with the service sector and the remainder of the economy. For all intents and purposes, the 2020 situation disproportionately impacted the service economy quite substantially. And more importantly, when you look at our employment projections going out into this year, you'll notice that it does get better, but overall, national employment is still running 8.4 million jobs below where it was pre-pandemic. And that's quite an important characteristic of this economic environment to understand, because for the restaurant industry, national job growth is a very important driver of restaurant sales growth. And the reason for that is twofold. One is that when people are employed, they have less time for at-home meal preparation. And secondly, they also have higher incomes to support restaurant spend. So this is a large gap. It's still 15% below where it was pre-pandemic, and it's not going to be made up this year. Getting back to that employment level is easily into 2022. And even if you just look at the characteristics of employment over the past year, you can see that the growth rate really peaked there in the summer in June, and then it decelerated, actually went negative, and has been coming back a little. But once with the outdoor dining and the easing restrictions, employment growth will pick up, but it's certainly not an environment this year as it was pre-pandemic. Another important characteristic to understand of the employment market is where that employment occurred and where it will reoccur. So for example, if you look at the employment growth from 2013 to 2019, employment growth in city centers, in other words, metropolitan areas, was nearly double that in rural and suburban areas. And as a result of that, how operations opened and how they growth proceeded was a tale of really two cities. And so, for example, a lot of the independent restaurateur growth in these city center areas helped the independent component. And the most important part really of the demographics coming up over the next year and beyond is what happens in this remigration pattern, because we all know that there's been an exodus not only of citizens, but also of office staff and employees out of these city center areas. And once the remigration starts, which it is obviously now, even if there is a return in numbers, the chance is this remote work does still remain a factor. And so if you have employees that are coming into these city centers 2-3 times a week, that's better than it is now, but it is not a return to the patterns which existed pre-pandemic. And even during the pandemic, certain restaurant operators obviously shuttered their operations in these city center areas, and consequently moved some of their operations out to where the population growth was expanding in these more suburban rural areas. So
Hudson, I'm so sorry to interrupt you. We've had a couple people ask you if you can change your display setting. They're seeing the next slide in the notes piece of your presentation and would love it if it was just a little bit larger, that the slides were actually just what shows up.
okay.
Thank you.
All right. So anyway, basically looking at what goes on with income, the stimulus impact is substantial. It's interesting when you look at the 6 congressional programs, as well as what goes on with the Federal Reserve, you're talking about income growth that is unprecedented, a stimulus well in excess of $11 trillion over the past 14 plus months. So the income growth, you'll notice, does resume fairly normal patterns in the quarters as they progress. Certainly, this looks at disposable, in essence, inflation deflated personal after tax. And personal income is more than just wages and salaries, for example. It is transfer payments, rental income, interest income, for example. So the real income growth this year, while not as strong as last year to compensate for that stimulus, it is moderate growth, but it certainly is not going to be exceptional growth as a result of what goes on with employment.
So Hudson, can we get that slide back for just a second? So what could happen with disposable income in 2021 is that during the pandemic last year, there wasn't a lot for people to spend their money on. So we've accumulated close to $2 trillion in savings over and above that would have been normally expected without the pandemic. So a big percentage of that disposable income from 2020 was not spent and will likely be carried over into 2021. Hudson's chart shows an average of 15.8 trillion in disposable income last year, increasing to 16.3 trillion in 2021. But that number could possibly reach as high as 18 trillion if consumers choose to spend their extra savings. That'd be a 15% increase. That's probably not going to happen, but something in the 5 to 10% range, I think, is reasonable to expect some of that savings to come out and turn into spending with that pent-up demand that's there. I think this is what economists are referring to when they refer to pent-up demand. So disposable income gains plus a pile of savings, and it could make for a very interesting year. Back to you, Hudson.
Sure. And it's also important to understand how consumers' spending patterns have changed and will continue to impact restaurant spend in the years ahead. This basically looks at last year, the percent of spend on the different categories. And as you would expect, the proportion spent on housing increased while the proportion spent on transportation and food decreased. Now that will change, but you'll notice it's food, both grocery and restaurant, is just 12% of the total spend. So, when we talk to restaurant operators, we emphasize how important it is that they understand the competition is not only other restaurateurs, but to get that dollar into the food service category to begin with. And obviously, as time has progressed, historically, decades ago, the proportion spent on food was larger. And it is interesting, the industry has really done a good job over the years of garnering a larger share of the food dollar in an environment where the proportion being spent on food is contracting. All right, so against that spend, obviously in transportation, what goes on with the gasoline prices is important. You all know that it has obviously been moving up as the economy gathers momentum. From the consumer perspective, cash on hand, credit on hand, gasoline is a very important determinant of restaurant spend over the long term. So obviously what goes on with gas prices as well as diesel prices for the supplier community has a big impact not only on operation costs, but on spending costs among consumers. And I know, John.
I can pipe in on that one. Yeah, fuel prices are definitely up sharply from a year ago, but if you compare to 2019, the Energy Information Administration is forecasting gas prices in 2021 to be up just 2.3% compared to 2019, and for diesel prices to be down 3.9% compared to 19. Prices are forecast to actually be a few points lower in 2022. For the most part, I think American consumers can live comfortably with gas prices under $3 a gallon, and that looks like where they're going to stay. On the business side, diesel fuel has not been the driving force behind record high freight rates. That's more a function of demand and capacity, and that situation has no chance of easing until at least next year. Furthermore, the boom in online spending has lit a fire under imports, and that's triggered further supply chain issues with shipping delays and shipping container shortages. Supply chain lead times and shortages are right behind staffing as top problems for supply chain professionals. So, fuel prices they're definitely higher. Luckily, it looks like we're under control there, and it's not going to continue. So, we're back to basically 2019 levels, which should be manageable. Hudson.
Okay. So moving on to other, in terms of the consumer spend issues, what has happened in the debt structure over time does impact the ability of consumers to spend at restaurants. This just looks at the total debt balance, for example, over the past decade plus. And the yellow-orange sectors are mortgage debt. And that's not surprising, that's the lowest one, but you'll notice the red, which is student loan debt, is now the second largest debt burden for the typical consumer. And it's important to understand from both an employee as well as a consumer perspective how this translates into the ability to spend, because in many instances, these are fixed payments against monthly cash stream. In fact, it impacts older consumers as well as younger. In fact, about 25% of the student loan debt is held by individuals that are 50 and above. So it is a developing challenge, not only for the industry, but for the overall economy. Also, too, what goes on with travel and tourism. 1 out of every $4 spent in a restaurant is travel and tourism related. Certain areas, metropolitan areas, are substantially higher. But this looks at what's going on with the TSA screenings, and it gives you a good read as to how travel is coming back, which is good for the industry, but there are 3 different components to look at: leisure travel, business travel, as well as international visitation. And it's that international visitation, which is definitely the weakest, followed by business travel. And so those are going to take longer to come back. And for restaurant operators and suppliers located in areas with disproportionately high historical international visitation patterns, it's an entirely different challenge for the restaurant spend in those areas. So moving ahead to industry performance, basically the initial forecast, 899 billion, came in at 659 billion. That's a $240 billion drop, 27%. It's going to take a while for the industry overall to get out of the abyss. Certain segments obviously actually did a little better during the pandemic, those that were convenience driven. But the fact is, now with outdoor dining coming back and on-site restrictions easing, the forecast is for at least a double-digit gain going into 2021. And obviously, a lot depends on the sustained impact of those vaccinations and getting the travel and tourism back, as well as the meeting business. And initial indications are obviously a lot more is opening up. But as we've said many times, 2021 is a year of transition for the restaurant industry. And looking at how consumers spend their money on food in America today, pre-pandemic, over half, 51% of the food dollar was allocated towards restaurants. It currently is coming in at 49%. That gap is closing. So I think some of the euphoria of some of these grocery store execs is a little misfounded. Americans love to use restaurants, and as long as they have the income and availability, they will patronize. And so that proportion in the depths of the pandemic was down in the high 30% range. But obviously it is improving and will continue to improve in the months ahead. Now, looking at restaurant sales on a monthly basis, you can see the pre-pandemic high there monthly. This is eating and drinking places, about 70% of the food service industry. The rapid plunge there down in April, and then the gradual build out. And you'll notice that the bounce up there in March, and that'll obviously continue into April and May, particularly with the stimulus and the easing of restrictions. For every week during the pandemic and even before the major onset, the association surveys consumers, 1,000 nationally projectable sample, and we looked at it by day part. The navy blue line there on the top is dinner, the red is lunch, the green is breakfast. And you can see that rapid plunge there in the second quarter of last year, and then the gradual build out. But it is important to note the substantial gap which still remains to be covered for these on-premise traffic occasions. The off-premises, obviously, as you would expect, improved overall. And if one thinks about the off-premises market, it is an extremely convenience driven market, where on-premises is more of a socialization driven. So the drivers for both of those operational differences are substantial. But the off-premises, particularly with the integration of technology, which we'll talk about, really has improved substantially. And the fact is, American consumers are much more comfortable now with ordering, particularly digitally online, restaurant meals and beverages. And so that capacity, that technology investment overall is not going to go away. And so we're frequently asked, well, what happens to that off-premises business once the on-site is open up again? And we strongly believe that off-premises market, while it's not going to be at the levels it is now, there is a permanent shift towards that greater utilization in addition to the usual on-premises.
Yeah, Hudson, I know I saw stats that consumers have heavily invested in working from home, and that's probably never going back to pre-pandemic levels. You know, if we don't look at dollars, if we looked at actual meals consumed, we lost a couple of points to on-premise versus at home after the financial crisis. And roughly, I think it's 80% of meals are consumed at home, and we'll likely lose another point or two after this situation. So, it is so important for restaurants to continue even post-pandemic to focus on that at-home crowd. That is where the numbers are and where the growth will probably continue to be.
Right, because I mean, from the consumer perspective, there's nothing more convenient than having the restaurant come to them. And you can see here for a couple of decades now, the association surveyed on what we call pent-up unfulfilled demand. And you can see the blue bars are the on-premise unfulfilled and the yellow bars are the off-premise. And so, as you would expect, in April, the on-premise pent-up demand was 83%. It has eased somewhat, but it's substantially above where it was pre-pandemic. And as you would expect too, with the off-premises, there's still a substantial pent-up demand, but it has eased and is currently below the pent-up demand for off-premises pre-pandemic. So the association also surveys hundreds of restaurant operators each month and asks them what their top challenges are. And as you can see, coronavirus is no longer the top challenge. Recruitment, retention of staff has really moved up quickly. And so it varies by geographic area, obviously, but the fact is different operators have different recruitment and retention challenges now. And it's a pretty unprecedented market in terms of getting staff on board that wasn't retained. And there's a lot of pretty unconventional marketing and development activities going on now in that certain operators are even paying job applicants to show up for an interview. So this will remain an issue for the months ahead. But as the overall national employment situation improves and the economy improves, recruiting and retention should ease a little. But in normal economic times, it traditionally is the top challenge for restaurant operators.
So Hudson, that brings us to the question of the year is, how do we find people to fill these jobs? And the other one that someone asked is, does the NRA have any initiatives to help members staff up?
Sure, I would recommend you look at our educational foundation sites, restaurant.org foundation. And what you can see there is, in addition to different discussions about how to develop and attract and retain staff, the foundation runs what's called a Pro Start program, which is a career and technical education program that teaches high school students culinary skills and management practices. And so the foundation is obviously centered on developing tomorrow's industry workforce. And there are a variety of different ideas and options there. For example, Serve Success, which was created by our food safety ServSafe team, it basically works at developing front of the house staff. Particularly for younger individuals, it's important to communicate the career paths which are possible, and particularly in this environment where staffing is so much needed. But in the end, the restaurant industry has always been a labor-intensive industry. It will continue to be. Technology has integrated some and is definitely helping productivity and efficiency. But in the end, communication, not only to consumers is important for operators, but also communication to potential employee pools. And that isn't just through the traditional recruiting venues. A lot now is done on social media. And one thing the association does is have in their background and of development materials of great ideas to how to recruit and retain employees. But in the end, there's no substitute for being a proactive restaurant operator that is committed to the continual training and development of staff, because everybody knows it's easier to retain a staff member than it is to go out and recruit one. And particularly now that the labor pool, for a variety of reasons, is definitely shallow. So industry employment proportionately is still down substantially, 15%. You can see, in essence, the second recessionary period which occurred for the industry there in the November, December, January timeframe. So industry employment will improve as the months tick by, but there's certainly no way in 2021 that the 1.8 million jobs will be regained over the remaining 7 months. So also too, as we all know, employment really is a very local issue, the opportunities, the demands. So this just looks at restaurant employment compared to February 20 levels. And you can see still there's not one state that is back up where it was to pre-COVID levels. So obviously the states in red and yellow are down substantially more, and the states in blue and green have had less of a decline. Another challenge for the operator community, in addition to staffing, is what's going on with food prices. And so if you look at the blue bars are annual menu price increases, and the yellow bars are what's going on with grocery store price inflation. You'll notice that on the far right, that 3.8% for menu price inflation, that's the highest rate basically since the 2009 timeframe. And even grocery store prices there at 3.5%. That's about the highest those have been on an annual rate since the 2011 timeframe. So from the consumer perspective, from the operator perspective, there definitely are challenges regarding the future pricing of food and beverage commodities. In terms of the wholesale food price inflation, part of the reason those grocery store prices were deflationary there in earlier years had to do with what was going on with overall wholesale food price inflation. But you can see this year for the first quarter, wholesale food price inflation is running at its highest rate since 2014. And as John knows well, different commodity groups have dramatically different variations. And the menu price theme of these establishments plays a direct role in their input cost.
So yeah, I think here, Hudson, it's very important to point out that 2.2% number is what happened in the first quarter.
Right.
And then April happened. And I threw up I've got a few numbers here, and I'm going to throw out last year for comparison reasons because I don't think it really counts regarding commodity prices. But if you want to look at comparisons to 2019 and comparisons to 5-year averages, during the month of April, corn prices averaged over $6 a bushel. They're currently $7.32. That $6 a bushel was 68% above 2019 levels and 67% above the 5-year average. Soybean oil, similarly, 57 cents a pound for April. It's currently 68. And even that 57 was double 2019 levels and 88% above the 5-year average. And it goes on and on. Hog prices up 60% over the 5-year average in April. 90s lean beef trimmings, which we need for burgers, were up 6%. Over the 5-year average and 8% above 2019. And that was an expensive year for beef. Wing prices are ridiculous. They're 80% above the 5-year average. And even cheese is 20% over the 5-year average. So, what I believe is going to play out over the year is you're going to look back at some of those numbers for 2010 and 2011 there on Hudson's chart. What we do have going for us this year is energy prices should stay relatively tame, but I know the March PPI jumped 1% compared to February. That's a 12% pace for the year. In March, the PPI was 4.2% above a year ago. So I think that 2.2% number could easily end up being something 4.4% or better for the year. And that is not just food, that's all incoming producer prices, and that's a really good gauge for the broadest swath of raw materials that go into the products that we buy. Had to throw in my commodity 2 cents.
No, and then on top of that, you put on what's going on with the drought conditions in the U.S. It's about 40% plus in drought now, and with the planting season underway. Obviously, that's not another good leading indicator of the harvests that are to come. But it's a situation that, once again, in terms of operator menu theme, plays a bigger deal in how they handle what's going on with their input costs, because as John was saying, basically that trend line this year compared to previous years is not one that engenders higher margins.
And this is one of the big things that's currently driving corn and soybean prices, and those are your feed inputs for your proteins. So it looks like it's shaping up to being one of those years on the food cost side.
So in terms of what operators did during the pandemic and how that carries forward, the most common item was generally streamlining the menus, making them simpler to execute for a variety of reasons. A lot of this had to do with the digitization efforts of making sure that those menus, when they're all online, are simple to comprehend and to order. But you can see the difference of operators going towards fewer menu items in the table service versus the quick service segment. That if you look at those yellow bars, which are the fewer menu items, table service, particularly the fine dining, was really where the simplification efforts occurred. There's also what we call the emergence of the streetery. In other words, the ability of restaurant operators now to expand that popular outdoor seating to a parking lot, a sidewalk, or even a curb. And that really did help the table service segment. And there are certain municipalities now that are in the associations involved with this on a local area to try and get a lot of these waivers much more permanent, because it is popular with consumers, and truly was a lifeline, particularly during the winter months for many, many operators. And you can see how the outdoor dining is returning. The far right bars, April 2021 of the blue and the yellow. You can see that for full service operators, basically it's 3 out of 5 at last month and 1 out of 2 for quick service. Another important component, and this is particularly for younger cohorts, consumers, the upgrading of the takeout and delivery packaging. This is twofold. Obviously, there's an eco-friendly sustainability component to it, but also to preserve the food integrity. And if you look at what's actually being delivered now, compared to what was capable of being delivered several years ago, it is a world of difference. And as you would expect, food service packaging has become much more innovative and much more technology driven. And so going forward, there really is going to be a greater emphasis on preserving how that food and beverage arrives ultimately to the consumer. Another additional lifeline was what went on with the ability to add alcohol beverages to the off-premises. You can see that for millennials, obviously, it really is an important decision point. And for example, for many table service operators, the ability now, working in tandem with local and state governments, to allow the ability to have the meals delivered with alcohol beverages. And that is an important component. And certain metropolitan areas going forward have agreed to extend, and others are having it under review. But the fact is, this was another issue that allowed operators to take a previously untapped market to a point where it is meeting consumer expectations now. Another development has to do with how consumers pay for their meals. I mean, there's a host of new activities. Meal subscription programs obviously is occurring across the board now. A lot of experimenting going on. Some focus on just specific food and beverage items. But the fact is, particularly the younger individuals are used to subscription programs, and it is an interesting way whereby certain operators now drive additional incremental business into their brands and establishments. So moving on to technology, obviously technology is a productivity and efficiency enhancer. 1 out of 3 consumers report that there's not enough technology currently used in restaurants. And so areas in which they'd like to see gains made, not surprisingly, ordering and payment, improving service off-premise, make it faster and more convenient, as well as providing more information. And so going forward, technology really is a strategic differentiator, particularly in these convenience markets. And from the consumer perspective, their activity of using all these different technology areas is pretty pervasive, but a lot of it is not particularly sophisticated, such as looking at menus, hours of operation, directions, ordering, reviewing, and mobile pay obviously became very important for a contactless environment, tablets, ordering. So as a long-term strategic development, the greater resource allocation towards this technology really does become quite important. And even if you look at mobile pay, not surprisingly, it skews younger. But the fact is that this is one area that technology, because it is becoming more widely available now and accepted, can really increase the convenience of these off-premises as well as on-premises occasions now.
So Hudson, I had some stats from the MPD group that said digital orders were increasing at a 23% per year pace pre-pandemic and jumped 148% during the pandemic. And they've now gone from a 6% share to an 18% share of all orders. So if nothing else, I mean, you absolutely have to just to be in the game, you have to have digital ordering.
Right. And obviously, one of the more important aspects about this digital ordering now is to integrate these frequent diner programs into that online ordering experience. And in many ways, consumers have become conditioned to expect to be rewarded for their loyalty. And that certainly is true now across the industry. And the fact is the technology is now available to seamlessly integrate this. So it is become an increasing expectation regarding the consumer. And also too, this ability to really integrate on-demand television and the streaming services with the staying at home and the additional points of access to shorten that delivery period. So that once again, in many ways, the pandemic really expedited the integration of a lot of these innovations. And when you survey restaurant operators, the yellow bars there is at the proportions that expect to keep some of the changes, and it is quite high. Roughly about 7 out of 10 operators say they're keeping some of them, and it's really just 2 to 4% that aren't going to keep any of them. So to wrap up, the association released pre-pandemic just barely the 2030 outlook, and in terms of long-term development trends, obviously what constitutes a restaurant in America is changing. It's more important to view it as points of access now, with the rapid focus on that off-premises, and more importantly, the digitization of having virtual digital restaurants that are not in traditional restaurant locations, as well as not accessible to the public. Off-premises opportunities will continue to drive industry growth, but unfortunately the margin pressures, particularly heading into these higher inflation times, are going to continue. And so from an operator perspective, the ability to manage the food costs and the occupancy costs and the labor costs becomes paramount. And a lot of these systems really do capture a whole host of new data available to operators, but the challenge is really turning that data into actionable knowledge. And so going forward, more of the technology capability will be directed towards improving the operator decision making, because in the end, good business decisions are made on good data. And then finally, the demographics obviously continue to change for both the industry, consumer, and employee base. In terms of the disruptors over the next decade, in many ways, it's important to think of these as opportunities. Obviously, the intelligent restaurant, the integration, for example, of artificial intelligence to predict demand, to alter menu pricing by time of day and specific location. The additional points of access and the increasing acceptance of consumers of using these digital only brands and the digital extension of existing brands. The focus on using these smartphone apps to allow independent operators greater exposure and capability of tapping into not only loyalty, but also the off-premises market. The autonomous vehicles only gathering momentum now as the economy picks up. The ability to engage these in support of the off-premises market is important. And then the filing of big tech bundling food with a lot of these streaming services, whereby it makes it seamless for the consumer to actually order food and beverages while in the streaming service. So the operator outlook for the general economy 6 months out is pretty high, 70%. Expect better conditions. And you'll notice it really has moved up smartly in the first quarter of this year. In terms of GDP growth, obviously a overall reaching of the pre-pandemic levels, but the income growth, once the stimulus effects start to wane and employment remains below levels, does become more of a challenge. Inflation definitely picking up as employment growth, but in terms of regaining all those lost jobs, it definitely is into 2022. And in terms of the basic demographics of the industry, this just looks out over the next decade, and those states in red over a 10-year period have population growth of less than 1% over a 10-year period. So if one is an operator or supplier focused on those areas, it's an entirely different situation than being located in those green and blue states. So to wrap up, the industry recovery in 2021 is a year of transition. Very, very strong geographic variations are maintained. A lot of disruptive macro trends, societal, economic. But the fact is, many of these do end up being opportunities for new channels of growth. Consumer pent-up demand is substantial and definitely aids industry growth rates recover this year. In terms of greater operational focus, obviously that off-premises market, the addition of alcohol in certain capacities, and that value-added product whereby that labor is shifted down the supply chain becomes more important, as well as the digitization of many of those menus. So from the consumer perspective, it still is an environment where they're managing their total spend. And so consequently, the ability to use technology to offer competitive advantages is extremely valid, and consumer acceptance of the technology is rapidly growing. So that wraps it up from my perspective. I'll turn it back over to you, John.
Well, Hudson, it looks like we've got a little bit of time left here. How about we hit a few of the submitted questions?
Sure.
One, how many restaurants have closed permanently? What about new restaurant openings? Is there a partial offset there?
Yes, the association estimates that at this point there are still 90,000 establishments that are either temporarily or permanently closed. But the pace of reopenings of the ones that I refer to as hibernation, those are starting to come back online. And certainly that stimulus effort is a big, big help in aiding these establishments to open their doors. And that in tandem with the new grant program definitely means that number is coming down. But even in the pandemic, it remains an extremely competitive industry. It always has been, it always will be. But in a way, it's that competition which has given the industry its extreme innovativeness, as well as its ability to rapidly change to evolving market conditions and consumer preferences.
So I found this one really interesting. What's your perspective on how having fewer restaurants due to closures will impact remaining on-premise restaurant sales? Will unit sales increase at a faster rate than the overall industry?
Once again, as we always say, all restaurant sales end up being local. But the fact is, if you look at restaurants per capita heading into the start of the pandemic, it was at a record high. In certain markets, obviously, there was a overcapacity challenge. And in some areas, that capacity has obviously to absorb new consumer spend diminished. So it's always important to think a little longer term in terms of ultimately how restaurant spend progresses. I mean, there is this substantial pent-up demand, And it's encouraging, and obviously new operations will open, existing ones will come out of hibernation. But the fact is, the competition, particularly as it relates to different markets now having the development of these virtual ghost kitchens, you can no longer, as an operator, really eyeball your trading market and have a good sense as to what the competition is, because still with 80% of that traffic off premises, it no longer means that you can know exactly what the storefronts are in your area. So as going forward, this is an area which requires great scrutinization and knowledge, because it is an area where certain metropolitan areas, dependent upon the remigration patterns, could become quite competitive pretty quickly.
So let's one last question, then I'll wrap up. So consumers have taken price increases and kind of accepted them so far. Myself, I just love eating in New York City and seeing that extra de Blasio tax on the bottom of my bill. But how fast do you think it'll be before lower price points and value wars return?
Not long, actually, because as I mentioned earlier, the two most important drivers of restaurant usage are convenience and socialization. And so particularly for convenience-driven occasions, the ability to compete on price and promotions and short-term offerings is intrinsic to those different brands and establishments operationally. So you'll see this on two tracks. Obviously, the promotion in the table service segment is somewhat different than it is in the quick service segment. But in the end, because even as new establishments and the net number of closures decreases, consumers want to allocate a greater proportion of their food spending towards the away from home market again. And it's a fact which has been sustained over the past decade in terms of how the consumers use restaurants. And even though it isn't instantaneous this summer, over the longer term, that proportion of the food spend definitely moves up again and will exceed its pre-pandemic level.
All right, Patty, you got a last slide you need to throw up as I go through closing comments here? Thank you so much for joining us today, but we are out of time. We've got two more gatherings scheduled. The next one is on June 17th, and it's titled Distribution and Logistics in the Age of COVID. It will feature Bob Sala, founder and former CEO of national distributor DMA. So unless you think you've solved all your distribution issues and they'll be resolved by June, you'll have to tune in for that one. That's all for today. Thanks for joining us, and thank you so much for Hudson for a great presentation. Goodbye.